My name's Nathan, the global CEO of BitMart Exchange. Today's panel will be deploying capital into on-chain vaults, and the focus is really what it actually takes for institutional allocators to move real capital into on-chain vaults, including the valuation process, internal hurdles, and what live deployment actually looks like in practice. And by way of background, I also came from TradFi before moving into crypto. And the questions that we've always asked for about any new instrument were always related to the risk management side of things. Can we custody it? Can we explain it to a client? And also, when can we exit when we need to? And I know this is a more institutional focus, and there's a few topics that the organizers would like me to cover, but I think that just to kick things off, I think most recently, I'm sure some have come from DAS. I think you you had mentioned that earlier. On-chain's the talk of the town. Now, I saw something interesting online on X that, after having conversations with multiple trading firms, the view is that on-chain vaults are really sort of the best way for a lot of these trading firms to sort of get retail participation and bulk up their AUM. How do you guys feel about that?
Yeah, let me start this. So my name is David Vatchev, and so I'm head of tokenization at Fasanara. Now, to set the context on this, Fasanara is a real-world asset manager focused on asset-backed lending. So we make a lot of our yields via effectively short-duration credit. And we're quite unique in that we also have an in-house crypto hedge fund. So we're very DeFi native, and we've been this way since 2018. So we have a bit of both the RWA side and the DeFi side, and my role sits at the intersection of that. Now, super interesting point that Thomas mentioned. The way we look at vaults and how we assess them is almost like a container which has something of value. Now, what's so game-changing about this is once you make this programmable using smart contracts, composable within DeFi, and allowing you to be able to have a new range of accessibility that wasn't otherwise possible, it's a complete game changer. And you have all of that visible to everybody on blockchain rails. So for us, we look at it, one, from a distribution side, but two, from a capital efficiency and risk management side, from our perspective.
Yeah, I mean, I can only agree on what you said. So we, Laszlo Szabo, co-founder and CEO of Kiln, we last year were the largest independent staking company. We're working with hundreds of institutions, and we see ourselves as an on-chain yield platform. So we started to distribute vaults 2 years ago with some of our customers, 25 wallets, the like of Ledger, Safe, Trust wallets, where when you access these lending stablecoin vaults, it's actually us in the background that powers the API, powers sometimes the 4626 vaults itself. And we thought, okay, vaults, as you said, is going to be the next wave of on-chain yields, and this is a way how great on-chain asset managers that could be most of the time off-chain, and will start to pursue these strategies of on-chain to attract more users, will use that framework essentially to power yields. We just thought, okay, how can we bring a better standard product to mix DeFi with real-world assets? So that's what we launched RailNet, this new on-chain state machine that enables an asset manager to build strategies composed of DeFi lending, liquidity providing on-chain perps DEX or real-world assets combined. I guess just on the point you mentioned, so we just announced our partnerships with FalconX yesterday, where they essentially offering on-chain vaults for Bitcoin strategies up from 4 to 6%. There's of course a huge opportunity to offer yield on Bitcoin. There's no yield on Bitcoin today, and the reason they're doing it, as you said, is because they had an hedge fund. It's the on-chain asset, the asset management arm of FalconX Monarch, and they had a hedge fund for years, and they thought, okay, how can I access more retail capital, and essentially vaults enables that for them.
I'm Patrick Barrett. I'm the CEO and founder of MembersCap. So we're an institutional reinsurance manager based in Bermuda. So what we do is invest in a portfolio of liquid reinsurance exposures and deliver essentially uncorrelated yield. So I agree with everything that's been said. I guess the only thing I would say, and this is wearing the traditional asset manager hat, is it the fastest way? And it's probably the only way. I guess I'd quibble with whether it's fast if you're coming from a traditional perspective and you're sort of aligning what you're used to in a traditional world with what it takes to create a product that's actually going to meet the needs of investors in this space and be scalable and have the sort of risk parameters that are required to actually make it viable for a vault strategy. So I think if you are looking to distribute an RWA, really this is kind of the only path available to you now if you want to scale to a large degree. So it takes some time, and there's a lot of learnings to it. But yeah, I agree with what's been said.
Hi everyone. My name is Thomas. I'm a co-founder of Exponent. Exponent is focusing on interest rate swap trading on Solana, and for us, vaults are a way to simplify access to those complex strategies. Rate trading is not something anyone can do. It's more for sophisticated participants. And so we started working on what we call strategy vaults to really open access to those complex setups you can do for portfolio construction on chain. So it's more for us. It's more from a builder perspective, where vaults are a way for us to get distribution, onboard sophisticated asset managers who have the expertise to run the strategies on behalf of users, and on the other side, retail users who were kind of left out of those products and strategies can now access them and have professional players doing that on their behalf. So we really see vaults as the next logical evolution for portfolio construction in DeFi, where we've seen DeFi starting with those one-size-fits-all models, where all the protocols were trying to fit everyone under the same basket. Like you had pool-based lending protocols, you had AMM pools like Uniswap v2, where there wasn't really any active management possible on those primitives. And then it evolved so we could bring more capital efficient on-chain products. So you had isolated lending markets, you had CLMM like Uniswap, where you have to actively manage those positions in order to make proper returns and outperform others. And so for a lot of users, this is too much. And so vaults are really here to act as a layer on top to let the professional guys do that, and users still get exposure to those yield opportunities without having necessarily the knowledge or time to run those themselves.
Appreciate everyone's perspectives. So, and I'll frame this around some recent market events, right? I think Resolve Labs was recently hit with an attacker using a single compromised private key to mint 80 million unbacked USR stablecoins with just 200K of real collateral. And the token crashed from about $1 to 25 cents. And that fake collateral was sitting inside multiple Morphle vaults. So when from your perspective, when you first proposed putting your tokenized funds, right, whether FAST or MCM, into on-chain vaults or accepting sort of new stable coins as collateral, what sort of extra checks did your respective investment committees or risk teams sort of demand? And after what happened with Resolve, are there, did anything change to be more? Are they tightening that? Curious to know your views.
Yeah, it's a very good question, and I think the context is important here, because just as Thomas's points here, DeFi was really built around crypto primitives. So all of a sudden now you have institutions coming, the infrastructure hasn't caught up yet. And examples like this obviously highlight this, but importantly, the most obvious audit you would do, for example, smart contract risk, wasn't really there. Like that was independent of the hack that happened. So there's multiple layers of risk and assessment. Now, the most important thing from us is really the actual credit underwriting. So we as an asset manager do this all day long, and this is our bread and butter. So we really want to ensure the soundness of that collateral and the solvency of this as a first instance. Then there's the liquidity component, and especially the duration mismatch that we have between some assets that get put on here and the liquidity needs of DeFi. And then also a very important one for the RWAs side of things, which we're involved in, is oracles and within, because again, the data is only as good as the oracle receives it. And now, where does that come from? How is that verified? So for us, there's multiple levels, but ultimately it starts with, are we comfortable with the underlying collateral? Can we credit underwrite it? So if everything goes wrong, we're happy to own this at the value which we believe is fair.
Absolutely.
Yeah, the way we've been distributing a lot of these curators vaults on Morpho to some of our customers. So we've seen it's our job to explain, a lot of these platforms, what happened, how they could potentially enforce the unwinding, even in non-custodial vaults. These are features that we sometimes offer them. And I think the way you picture the risk is to decompose every layer. So, for example, our head of asset management was the ex-CEO of Curator. Curator was the first vault rating mechanism in DeFi. And we explain data room, which sometimes we work with the asset managers so that they can understand the collateral risk, the LTV ratio of a pool, the smart contract risk, the audits, the governance of the smart contract, which in this case was lacking, and the overall liquidity risk of the pool. The other part is you need to pick your asset manager very well, or on-chain asset manager or curator, if they prefer to call themselves like this. And that means that it might happen, right? Elements like resolve might happen. There's different strategies, different protocols, and you cannot be 100% sure that a smart contract is not going to be hacked. But at least you ensure that either the unwinding is done fast enough through tools like Hypernative, or just the team having the right monitoring tool in-house, or either they have the required balance sheets so that they can pay back the users. Because I can tell you that following the resolve events, some of these curators or on-chain asset managers have been paying back the users because they want to preserve their reputation.
Patrick?
Yeah, I mean, I would just say when you're designing the overall structure, I mean, we're applying the same perspective of diligence and working with the sort of, you can call them even like institutional intermediaries that are sort of arising now to advise on various aspects as you're structuring these products. But I just want to go to a point. I mean, that David mentioned, and one of the things that's just so important for our overall risk management is ensuring that the product itself, is actually liquid underlying, right? I mean, that's been one of the biggest struggles in the space, and I think it's why you've seen a lot of institutional managers struggling to scale their products because the underlying product itself isn't really liquid. So I think you're seeing a bunch of products come to market. We have really had to go back to the drawing board ourselves to create something. I think this is like one of the unspoken elements of trying to launch a product leveraging Vault infrastructure is your underlying product really needs to match with very particular risk parameters, liquidity parameters, yield parameters that don't come easy, right? High yield, low risk, low drawdown, and liquid are things that are very difficult to pair together. And so I think there's only a few asset classes, at least as the DeFi investment universe exists today, that are really kind of fit for purpose, outside of purely sort of crypto native things. And so that is really our kind of biggest focus for risk management overall in a product that's going to be able to sort of meet redemptions and maintain itself without a blow up.
Yeah, maybe just quickly as a Vault infrastructure provider, for us it's less about how, like, we don't think you can remove risks from those vaults. We think what's important is how you display them and make vault depositors aware of for instance, the asset exposure, what assets you're exposed to when you deposit into this vault, as well as the protocols. If you have, or vaults are, can do cross-protocol interactions, which means you can interact between multiple DeFi venues. And so it's very important for us that the vault manager is able to translate the strategy into the UI, so users can understand when they deposit what could happen. How can I lose money if I deposit into this thing? Is it maybe because this vault is exposed to lending protocols and so there's risk of bad debt, or maybe the collateral assets are more exotic and so there's illiquidity issues. So yeah, when we designed those strategy vaults, the goal for us was really to be able to almost like recreate this. In traditional finance, you have like a fact sheet with what the vault is supposed to do, what are the exposure, mandate, and all of that. And so our goal was to really replicate that, but also use the transparency that you have when building on-chain, because everything can be seen. If your vaults are fully on-chain, fully programmatic, depositors are able to see everything from the actual exposure, allocation history, and really get a sense of, okay, what could go wrong here, and am I confident enough to deposit into this vault and trust this manager to respect this strategy and follow it.
Thanks for that, Thomas. And maybe I'll just follow up with the next question for yourself and Laszlo. From where you guys sit, institutional clients often have monitoring in place, right? But in the case of Resolve, more full vault curators kept auto supplying liquidity for hours after that depeg and didn't react fast enough. So what do clients consistently underestimate about setting up real-time risk controls and automatic circuit breakers in live vaults? And what would you have told them to build sort of before that first dollar would go in?
Yeah, so monitoring is obviously very, very, very important. I think for us it's also a bit different because, again, with Exponent's vaults, you can do pretty much anything. Like you could interact with perp exchanges, you could interact with credit protocols. And so for us, when we talk to managers getting onboarded, it's really about making sure they know exactly what they want to offer. And so think about, okay, what's the vault mandate? What do I want to achieve with this vault? And not change it in the middle, because then depositors will potentially lose trust. Like if you're depositing into a vault that's supposed to maximize credit returns and do some looping on Morpho, for instance, you don't want the vault 2 months later to start doing some market making on Uniswap or another order book on Solana. So when we talk to managers, we really try to work. It's their job at the end of the day to run the strategy, but we try to work with them to make sure it's clear what they're trying to offer. And then it's also easy. Once you know exactly what the vault is supposed to do, it's easier to manage all the risks involved with that strategy, because you're not like you're constraining the strategy into something very specific, and you're not trying to do everything at once.
Yeah, I think first of all, we will work with the platforms and these institutional players, with essentially what type of DeFi protocols or real-world assets they want to be exposed to, and then they will essentially mission an asset manager to only allocate into these protocols or real-world assets, right? So in the case of Resolve, they will try to understand, the governance of the contract, the liquidity risk, the risk of depegging, and so forth. The second thing is, again, there's in some of these vaults, they have admin rights to sometimes force exiting the funds back to their user wallets, either through their watch or through an automatic setting through IP native or other type of monitoring tools, where you say, okay, there's a hack happening, you can trying to unwind as fast as you can. And if that's not the case, then they will work with the asset manager, which I might need to pay a bad debt, in which case this asset manager better be very well capitalized, potentially regulated. So I guess these are kind of all the elements so that you ensure platforms when offering vaults to the users don't get stuck in resolve events if they happen again, and they will.
Okay. Well, I'll switch it over to the next one for David and for Patrick. So, you guys have obviously made your allocations into on-chain votes, and to scale up, right, when everything looks stable. But now that we've seen what happened with USR collateral causing real losses and bad debt in several of these Morpho vaults, what would sort of give you the confidence or the hesitation to increase allocations? Again, if a similar sort of tokenized assets showed up, I know you guys had mentioned several key sort of criteria, whether or not it's performance data, liquidity, curator reputation, or something else. I'm curious of your thoughts.
Yeah, and not to repeat everything that was said, which is super important, and the parameters, but having a bit of context on this, we talk about asset managers. So we are an FCA-regulated asset manager. Now, we don't just snap our fingers and get that. So that takes a lot of time, and we have a fiduciary responsibility to our investors. Okay, on-chain, I can spin up a vault, and I'm called an asset manager, and I can curate that for you. And then who bears the risk? So from our side, it's really a case of how we see the industry evolving is who has been able to navigate both the real world asset side and be able to actually do the credit underwriting, be able to understand how asset management works from a TradFi perspective, but also have that DeFi fluency to be able to deploy capital on chain, to be able to lend, to be able to borrow, to be able to set the parameters and curate the vault, because that marries the best of two worlds. And what you find at the moment is the worlds are still trying to come together. And Patrick made a very important point regarding the liquidity elements, which is being solved. But more broadly, it's how somebody who's off-chain interacts on-chain and how they bring about the best practices of TradFi is really what we're focused on here. Because as we've just mentioned here, you're not going to be able to remove any of these risks again. It's about risk management, which is what we do all day long.
Right. And, you mentioned, who sort of can you trust on the credit underwriting? I mean, even with the best practices on Wall Street, I mean, we still see time and time over again, those sort of underwriting, Wall Street still continues to take excessive risk over a period of time. It always comes sort of in ebbs and flows. And I think especially these days, what's been talked about a lot on the private credit side, not necessarily just the duration mismatch, but really sort of how liquid it is and how fast you can react, because all of these private companies, it's a lot of these are sort of they're not very diversified in terms of their actual businesses. So if it's one or two variables change, that can dramatically change the projected cash flow and debt repayment for the business itself. And and there's a lot more. I think folks in the sort of Web3 natives now are starting to also understand this more as they start digging into, okay, what's under the hood for some of these vaults and private credit related assets that are underlying. Do you have any sort of view on that? Because it just seems like we're taking very similar things have happened in the past. Just maybe, you can call it subprime mortgages, CDOs, CLOs. I think on the loan side, these standards tend to change when, folks have internal sort of goals and targets to achieve. So how do we kind of address this?
Yeah, it's an important point. And by all means, TradFi is not perfect. The only thing where I would say is a differentiator is the mechanisms of recourse are there. And so again, whether they work perfectly or not, I think people in different jurisdictions know when things go wrong, what happens. Whereas obviously in DeFi, it's very much not the case. Now, importantly, with what you mentioned within private credit also, again, it comes down to effectively a mismatch of expectations. Actually, nothing here went wrong at all. These are multi-year loans, direct loans to over-leveraged software companies that were effectively packaged as these BDCs that was sold as semi-liquid instruments to retail. So then retail does what they do and thinks it's a Nvidia or a Tesla. They hit the sell button, and then you have this. Actually, nothing has gone wrong. Now, what is important though is what we've been discussing before about the underlying. So we at Fasanara do a form of private credit, which is asset-backed finance. Now, this is very short duration credit. Effectively, this is invoices, receivables, 30, 60, 90 days. So the liquidity is effectively self-amortizing. So we can match that and bring that into DeFi. And we start that as a base. Can you see? It would never really work if we had multi-year loans and we tried to package them into DeFi right from the start.
That makes sense. All of them are short duration. You can easily, it's very much liquid, and you'll receive that cash back. Okay.
Yeah, I mean, I'll just add on. I think we always need to remind ourselves that we are at a frontier of what's happening in both technology, but also finance. And so what you're constantly struck by in these conversations is the leading lights, if you will, in this space. And you're having conversations and you realize sometimes you're talking past each other and just using different terminology, or you're not quite, there might be a slight nuance, or there's not a full understanding of what it is we do or they do. And other times there's just gaps in understanding. And then you realize it's because actually no one's really had to think about this as a first principles matter applied to, a very complicated process with very, very heavy risk management on top of that. And then trying to game that out and figure out in a novel way, where are the risks to us? Where are the risks to investors? Where is the overall risk in this platform? And so this was to my original point about thinking of risk management. It just takes a lot of time to think through those things. And so I think when you start to see, RWAs like Fasanara and ourselves, who come from an institutional perspective fundamentally as regulated asset managers, there's a lot of time and thought that needs to go into these things because it hasn't really been done before. I also think from the investor's perspective, sorry, my voice over the last few weeks of speaking and conferences has absolutely been shot. We're right at a point now where I think there's still not a lot of focus on, okay, what is actually in these products, and are they high quality yield products, or are they simply, are we focused on attributes that are sort of generically applied to them? So for example, in the reinsurance space, there's a whole range of insurance and reinsurance, but there's really only one sliver that's the institutional asset class, where you see pension funds and you see sovereign funds and endowments and big hedge funds. So it's important that there's a level of transparency there, and that when you are, from the investor perspective, diligencing a manager and ultimately a product on chain, that what you're being sold is actually in the box, right? And so I think, where we are now, there will be a huge differentiation as certain asset managers figure out how to make liquid products with the right yield profile and the right risk parameters, while still putting in institutional quality, high quality assets. And I think those are the ones that are ultimately gonna succeed and scale over time, as incentives and other things kind of fall away on projects that maybe started with like a technology first approach, right? Ultimately, we need to start with product first, and what is the underlying investment manager's perspective, and then we're essentially applying technology for distribution, right? Now, it's not that sexy to talk about it that way, but that's fundamentally what we need to do.
Right. And, when you mention distribution, I think the case is very obvious for distribution to retail with these on-chain vaults. But because of, the summit and sort of what, the focus being institutional here, what's the one thing, the first thing and the most important that would truly unlock sort of the capital from the institutional side to put more and allocate more money into these on-chain vaults? Because institutions have access, right? I mean, access is sort of the key. I mean, that's why it makes sense for retail. I see that point. You have it sort of opens up the access for retail, but what about institutions? Do they actually need to deploy on chain when they can sort of get similar exposure in many other ways?
Yeah, I'm happy to. It really is. So firstly, operationally, just sort of the slightly boring point, very few asset managers or institutions can actually have the DeFi fluency to be able to spin up a smart contracts and to be able to actually manage and curate vaults. But over and above that, it's really what is the opportunity size. So we saw this earlier in the year when gold and silver was moving, just the delta of those moves with the entire market cap of crypto. So it has to be something of a meaningful opportunity. Now, we've managed to find success in the vaults that we've launched here. It took a long time to actually structure the products this way, and so we continue to build that momentum. But it really needs to have a tangible ROI on the asset manager.
Yeah, I think there's not one thing, but three things. First, we said it since the beginning of the panel is the risk, right? Really understanding the risk, different layers, from the collateral to the smart contract to the liquidity to the protocol or real world assets quality that this strategy is being allocated to. Second is, I think most of strategies today are very lending based. You borrow assets, you loop it 2 times your farm. Not very sustainable when it comes to bear markets, right? You could argue a majority of these yields now are just incentives programmed from protocols. I think institutions, they get that once they understand where the yield comes from. They understand that a big part of that yield will need to come from real world yields and real world assets. So I think mixing DeFi but having real world assets on-chain portfolio would unlock big part of this institutional capital, because they will start to understand where the yield comes from. And the last part is compliance. In compliance, we see it in 3 different ways. But I think you have either KYT end-to-end when it comes to wallets. You have KYC at the vault level, and then you deploy into KYT type of strategies when it comes to an exchange. I would argue that some of these institutional players, they are comfortable only using KYC end-to-end type of flow. So they ensure that all the funds in the vault are KYC'd, and they ensure that the deployment of the strategy, either in a KYC pool in DeFi or KYC real assets, is being pursued by an asset manager. So yeah, I would say these are the 3 things, and then just time. It will come.
Yeah, I mean, the first question they ask is, how does this fit into my risk framework, right? And it's very difficult for them to compromise on those things, which is to say it's impossible to compromise on those things. And so there's a lot of, I'd say, development from a regulatory perspective. Some stuff that's happened in the US maybe has opened up some pathways, for example, around stable coins. But it's like, how does this fit into my Basel III and Solvency II frameworks, right? That's just fundamentally how they're thinking about things. So that, yeah, I mean, that's perhaps the time element you refer to there. And then the other side, to pick up on David's point, is scale is a really big thing. We get asked all the time, how much can you deploy? And if your answer isn't into the billions because the market supports that and isn't going to distort the market or distort what you're kind of able to do, it's just not interesting as an institutional allocation, right? So those, I mean, there's 10 other things that are also very important, but I think those 2 are just the most basic table stakes that institutional capital, and it depends what we mean by institutional capital, but the big institutions, those things are just fundamental to first solve, and then ultimately we'll see scale, but those things need to be solved first.
Yeah, I agree on the time perspective. I think vaults are still quite young and just now becoming a bit more complex than before. I think vaults were really the main type of vaults we were seeing on chain, and now we're starting to see more complex things like cross-protocol vaults, which can be way more granular. And so I think for a lot of those big players, they want to see some success stories, some track records, to understand what's the potential for them to allocate time and efforts into either deploying into those vaults or even managing some vaults themselves. And they need to justify those costs. They need to justify having a team focused on that. As we said, you need to monitor risks. You need to allocate proper resources to it to do it right. So So I think as soon as we're going to start seeing some of those vaults becoming very big and driving a lot of traction for asset issuers or driving good returns for fund managers, we're going to see more of them being excited and joining the race to also be part of this vault segment.
Okay. And because we're running out on time, I think the last question, and this is really for me too, because coming from the perspective of a centralized exchange, and as you guys may know, centralized exchanges ultimately are now all employing sort of on-chain, the on-chain solution side, right? Whether or not it's your OKXs of the world focusing on their decentralized wallet or Kraken, so on and so forth. So for those that, I guess this, for my benefit, I guess selfishly here, what there's obviously pros and cons, right? I think for some may view it as, okay, is on-chain a destination or just the final destination for some of these funds? Because ultimately that it's effectively the final distribution layer for retail is on the centralized exchange side, which will have sort of shift a lot of that potential volume into the on-chain world. Now, for an exchange that has not yet fully embraced that on-chain, the on-chain side, what's sort of the key benefit from whether or not it's an ROI perspective or just longer term business viability? If I'm just curious, sort of your thoughts.
Yeah, I mean, look, everybody's chasing yield, and so this is why everyone's come to DeFi. This is why we're now talking about RWAs or so. Everyone's been doing the basis trade. It's completely effectively commoditized now. So this is why we're moving to DeFi, and people accept the risks. To your point about exchanges, the most obvious and simple benefit is a better consumer experience, but ultimately better yield, right? The idle stable coin reserves go into a vault, and you can see that happening already with Coinbase. It's happening with Kraken, various other exchanges. So it's the most obvious thing that you can do to your users.
It's most of the time in most region and jurisdiction regulatory edge. So MiCA is not considering on-chain yields and vaults. And there's a lot of large exchanges in the US, same in Asia. They feel comfortable essentially linking non-custodial wallets to the exchange UX, so that the user doesn't feel he's leaving the exchange, but he's still allocating these funds from a non-custodial wallet once he click on I want to yield on that vault. So that I'd say that's the main part. The second main part is, like, of course, the yield quality, which I think you find higher quality on chain than off chain these days. It's also much easier for an exchange to manage it, to implement it, versus having to manage all these yield product off chain, do the custody and the trading and the settlements daily themselves. If they wouldn't use a vault. So yeah, it's a better product.
Yeah. Well, we're running out of time here. Did you want to go?
Yeah, I can go. Yeah, just to quickly add on what was said by David and Laszlo. I think it's vaults are a way for exchanges to offer safer yield opportunities. Like, rather than trying to build themselves the strategies, they can work with curators and work with them on what kind of assets they want to offer to their clients and customers, what kind of strategies, and vaults offer a safer environment for the strategies. And we're starting to see really interesting success stories there, like Kraken recently and Veda working on some vault to offer that to Kraken users. And if done right, I think it's a very good product to offer to customers. And as David said, a lot of the main reason people come to DeFi and interact with those on-chain products is for yield. And so for those exchanges, it's a very big segment for them to be able to tap into those on-chain yield opportunities and offer them in a more control and a safe way to their customers.
Absolutely. The chase for yield, as David had mentioned, is exactly what I think every sort of market participant, especially in DeFi and Web3, are after. Well, thank you very much. I've certainly learned a lot from you guys on this panel, and it was a pleasure to host and moderate this one. So thank you.